Welcome back to accounting. So yesterday we dove into chapter 1, which is the intro to accounting. Now, in chapter 2, I'm actually going to talk about in depth what accounting is. So, we've mentioned before, right? That accounting is the process of recording, sorting, analyzing, summarizing data from all business transactions and events. So here's something that we covered yesterday, right? We covered that we are looking at the basic fundamentals of accounting 101, which you need to take first before any other accounting class, right? We're looking at the very fundamental backbone of a business, and we're focused around how to properly see how transactions affect a business and so on and so forth, and see how to measure profitability and where a business stands. So we are looking at financial accounting, right? Now, when we learn financial accounting, what we are ultimately learning is very similar to a new language, okay? I'll be using some terminology such as receivables, right? Or expenses, or payables, or assets, right? These all have some kind of meaning to them. So again, receivables means you to receive, right? Whether you're receiving a payment from somebody or whether they owe somebody, right? Or whether they owe the company some money. So that's why we need to receive payments from our customers. To pay, right? Usually when you're paying for something, it's usually an expense, right? When you owe somebody money, it becomes a liability or it becomes a payable, right? And it becomes also an obligation at the same time, right? Because now that you owe somebody, you're obligated to have to pay them back, right? And then again, if you own property, right, that becomes an asset, right? We talked about what assets are. So let's go ahead and dive right in. And as we go through this, we are slowly learning a new language at the same time. So you're going to end up picking up some terminology throughout the course of class. Okay. So let's start off with the very most important thing is going to be accounts. Accounts is our systematic way to keep track of our business transactions, and basically we're organizing them into 5 different categories. We have assets, liabilities, equity, revenues, and expenses, right? And each one, okay, at the end of the given time period is what we're going to be creating, right? We're going to be balancing them at the end of every given accounting period. So let me separate these 5 into further categories, right? Because your assets, liabilities, and your equity are going to be your permanent accounts, while your revenues and your expenses are temporary accounts. What does that even mean? For example, your bank account, right? You own the money that's in your bank account. So therefore we call that checking, right? That's going to be an account that you will see frequently. If checking is an asset, right? It's your money that's in the business bank account. What happens when you close out your checking account?
You have $0 left in it and no longer at the bank.
Yeah, okay, but what does it show to the rest of the world? If you close out your checking account, your business checking account.
No longer running transactions.
No longer doing business. Okay, so that's exactly why your checking account has to stay consistently open. So that's a huge difference between your permanent accounts and your temporary accounts. Is your permanent accounts will always stay open even if you've gone through a period of time, while your temporary accounts are going to close out every given end of your accounting period. Okay? So let's do another example, right? Let's do a liability, right? What happens when you close out a loan because you owe money to a bank account for taking out a business loan? What if you close it out? Can you close out a loan? You would have to pay the lender lots of money, right, to close it out. But at the end of the day, even if you close your business, they're still coming after you for that money. So in this case, there's no way that you can close out a loan unless you decide to pay off the loan 100%. But in this case, that's an example of why your permanent accounts must stay open at the end of every given accounting period. Now let's do an example of a temporary account. Let's say your accounting period is every single month. Now in this case, right, revenues is the money that you generate. Expenses are what you have to spend in order to operate the business. Okay? Are you able to predict a single revenue? Can you predict how much money you will earn in a month?
Yeah, you can.
How so?
Like a financial forecast.
Okay, but what I meant is like, can you expect the same customer to come to your store and buy the same exact item from you every single day, every single month?
Sometimes they have like recurring payments.
Okay, but I'm talking about in general. If I open my business every single day, can I expect the same exact customers to return?
Repeat customers.
Well, what about new customers? Is that not a possibility? What if my old customers decide to leave me and go to a different company? So those are going to be examples of why your temporary accounts needs to close out, because at the end of the day, you're going to get, yes, you may have reoccurring customers, but at the same time, you're going to have inflowing new customers. You're going to lose customers along the way. So in this case, can you really predict your revenues? Yes, you can do forecasting, but how accurate can you guess that this exact customer is going to come into your store on this exact day and buy this exact product? What if that same customer does come to your store, but they decide to order something completely different? You won't be able to predict a customer and what they want. Okay, so that's an example why you need to close them out, because that is a perfect opportunity to measure how much money you've earned. Same thing with expenses, right? Can you expect to spend money, the same exact money, the same every single month? For instance, advertising. Can you expect to spend the same amount of advertising expense every single month? No, because again, such as July, we had a 4th of July weekend, right? There's a perfect opportunity to spend some money for advertising. What about August? Is there any holidays in August? I mean, you could create one. Yeah, you can create a summer sale in August, but there's no holiday in August. So maybe you won't be spending as much advertising money, right? But maybe September you will, because it's back to school, right? It's Labor Day weekend, right? It could be fall season. In September, you probably be making more advertising expense than you would in any other month. But let's really think about it, okay? Yes, you will have your fixed expenses such as rent. Rent is something that you constantly pay the same amount every single month. Well, what happens when your landlord decides to say, no, this time I'm raising your rent expense. You need to pay me more. What happens to your fixed expense then? So in this case, it goes up. So your expenses are unpredictable as well. Every single month or a given time period, you will be occurring different operating expenses for every single different time period. So that is exactly why we close out our temporary accounts, our revenues, and our expenses at the end of a given accounting period, because this is a perfect way to measure profitability, right? If I can take my if I could take the amount of income that I've earned and counter them against my expenses for that month, then I'm able to make projections, make those predictions, right, in forecasting to let me know, okay, if I make this much money for this month, maybe I will roughly get the same amount next month, right? So in this case, that is exactly why we close out them at the end of the accounting period. Now, this won't make any sense until we dive into chapter 4, okay, where we get to see the accounting cycle, so tomorrow. But however, that's something that you need to know, that you have permanent accounts and you have your temporary accounts. Your permanent is your asset, liability, equity, and your temporary accounts are going to be your revenues and your expenses. Okay? So once we've actually understand that you have your permanent and your temporary accounts, right? Now that you know that there's only 5 and 5 only. Now, how do you organize your accounts? You have what's called main accounts, contra accounts, and sub accounts. Main accounts are usually going to be your general overall account, right? That flows in a specific direction. Okay, what do I mean by flowing in a specific direction? This means, does it flow on the debit side or does it flow on the credit side? Okay, now if we understand that if it flows in a specific direction, okay, then your sub account, right, is going to give the main account much more details, right? But the sub account, what it does is it breaks down the main account in detail, and it flows in the same direction as the main account. So for example, right, my main account is inventory. If I'm selling my inventory, right, that's a very generic account. Inventory could be anything that I want to sell, right? But if I want to be very specific about the items that I sell, I go ahead and break down my main account into sub accounts and say, well, I sell coffee mugs. That is my inventory that I keep track of, and I sell those specific items, okay? So there's an example right there. Now, what is a contra account? Well, contra, right, in English, the context of that word right there means opposite, right? Like contradiction, right? It means it will go in the opposite direction. Okay? But however, the contra account can be either or. It could serve as a main account, or it can serve as a sub account. Now, what does a contra account do? A contra account, what it does is it reduces either the main or the sub account. In this case, it flows in the opposite direction. So this category right here doesn't stand alone. Okay, make sure you understand that. It does not stand alone. There's a reason why there is a contra account, because it's just going to reduce either an account, which is either asset, liability, or equity, right? It's going to reduce it, right? Or flow in the opposite direction, right? So if the main account is flowing in the debit side, right, your contra account will flow on the credit side. Okay, so that's the huge things about when we're categorizing and organizing our accounts in a specific manner, right? We'll talk about the chart of accounts in the next chapter here. We need to organize it exactly like this. So imagine, for example, imagine you're opening up a textbook, right? You open up the first couple pages, you have your table of contents. What do you see? The first thing is the chapter title. And what you see underneath it, which is your sub accounts, are going to be the lessons that you're going to be learning under each chapter. So that's a great example of how we would use or how we would organize our accounts in a list. Okay, is we would use main accounts, sub accounts, and contra accounts, right? To understand how many accounts that we need to use and how we organize our transactions. Right? Any questions so far? Okay. All right. So let's dive into what a debit and what a credit means, okay? Now, it depends on which account you're looking at, but when we understand what a debit and a credit does, it does do both increase and decrease. Now, again, depending on what account you're using, a debit can increase a specific account, but it can also decrease a specific account. Okay? Now, how we understand debits and credits is literally we understand it as debit as left and credit as right. So imagine on a number line, right? As you can see, you got positive numbers on both sides, right? Because in the middle is 0. So if you're moving left 3 units, then you're going to be positive 3. But if you're moving right 3 units, you're going to be positive 3 on the credit side. So that's how we understand how debits and credits work is imagine you're on a number line, okay? If you are taking 3 steps to the left, right? How do I get to my credit on the right side? 3. I would have to backtrack, right? I would have to go back 3 units to get to 0 and then go back 3 more or go forward 3 more to the right side to get to that 3 on the credit side. So that's how we understand how debits and credits work. So that's why when I was talking about how debits can increase an account, it can also decrease it as well. Okay, so that's how we understand, and that's how we're going to be using the debit and credit system is we're going to use it as if we're going to be handling numbers on a number line. Okay, each account is going to be having some kind of account balance, and this is what this is, right? It's whether you're going to have a debit balance or whether you're going to have a credit balance. Depends on the transaction at hand. Okay? Now, do not refer debit as increase and credit as decrease because it depends once again on the account that you're looking at. Because once again, a debit can do both, increase and decrease. So can a credit. Okay? So do not refer them as one of them is increase and the other one is decrease because they both increase and decrease. Okay? So, right? So that's how we're going to be using the system here is we're using it as a number line. Yes.
Can you give an example of increasing and decreasing?
So if I were to take an asset, right? For example, let's say I want to buy something with cash, right? Let's say I bought something for $3. I'm sorry. let's say I deposited $3 into my checking account, okay? If I were to deposit $3 into my checking account, right, we know that that's going to debit my account. So therefore, I'm at a positive 3. But what if I want to go buy something and it costs me $6 and I only have $3 in my checking account? Well, that's okay. I'll just go ahead and charge that $3 and then pay on a credit card. So therefore, if I use my credit card or use my debit card, right, I'm going to decrease my checking account from $3 balance down to 0. Right? But if I charge the whole entire amount, then I'm going to be paying $3 into the credit. So that's an example of using a debit to increase, right? But that's also a means of using the credit to decrease. Now that's only one example. Okay? What if I have a liability? Okay? So let's say I borrowed $3 from a vendor. If I borrowed $3 from a vendor, liabilities are increased by a credit. So therefore, I'm going to go to the right 3. So I borrowed $3. And then a couple days later, you say, oh, I need to pay my vendor. So you're going to debit 3 because you owe them $3. So that's going to make you go to the left to 0 because then you don't owe them any money. So that's an example of using debit and credit as both increase and decrease. Okay. We'll have time to practice this in chapter 3. Okay? So that's how we're going to be using the debit and credit system here. Okay, so the next thing that we have to understand is going to be the accounting equation, right? The accounting equation here is going to be assets equals liabilities plus equity, okay? You also may have heard that it's equity equals assets minus liabilities. But in this case, we have to understand your equity contains much more than just assets and liabilities. So in this case, the number one rule here is your original accounting equation is going to be assets equals liabilities plus equity. Okay? No matter what given point in your business, this fundamental accounting equation must hold true at any given accounting period. Meaning if you were to run your business transactions every single day, this equation must be balanced. Okay? So that's the reason why when we do accounting, it's always checks and balance. You're constantly balancing this equation every single time you are recording your transactions. Now, is it necessary to test this accounting equation every single time? No, but again, there are ways that we do test this accounting equation, right? We test this when we complete our balance sheet, right? So again, there are times where we will be needing to use this accounting equation, but this is what needs to hold true at all times at any given accounting period. Okay. So everything that you own must be equal to everything that you owe plus the value of your company. Right? So let's actually break down every single account and talk about how we further categorize them and how we organize them. Okay? So let's talk about assets. What are assets? Well, think about it. It's everything that you own. So that means if you have some kind of ownership over it, it's an asset. Okay? So, for instance, how do we categorize our assets? We have 3 categories, right? Current asset, fixed assets, and we have other assets. Now, how we categorize it is based on how liquid our accounts are. What does that mean? Liquid means how easily convertible is it in cash, is going to determine how we categorize them. So again, our current assets, right? If you look at our example right here, cash. Cash is already in its liquid form, so that's why it's the first thing on this list right here. Right? Things like accounts receivable, where our customers owe us money, we can instantly get that into cash by billing them for what they owe me, right? Inventory, right? We purchase it. The minute we purchase our inventory, it becomes our property. Now, how we can convert that into cash is almost instant, right? All you have to do is make a sale and you have cash instantly. So that's how we organize our assets, is based on how liquid they are. Now, that's just the current assets. Let's talk about the fixed assets. Fixed assets are also known as PP&E, which is property, plant, and equipment. Now, use PP&E to determine whether an asset is fixed, because let's break it down. Your property is going to be the land that you're doing business on, the streets, the sidewalks, the street lights, right? Your backyard, okay? All of that's going to be considered property. You own it, right? Next is going to be your plant. Your plant is going to be your building, your business building, and everything that's inside it. So desks, chairs, tables, lamps, okay? And then you have your equipment. Equipment is going to be any kind of type of machinery that helps you operate your business. So refrigerators, right? Microwaves, right? Now in this case, again, equipment has some kind of electrical unit to it, or has some kind of power to it. So again, a printer will be considered an equipment. So that's how we understand, okay, if it falls in between any of those categories, then it will be a fixed asset. Now, what do we know about fixed assets? Well, let's take an example, right? Your building. How quickly can you convert your building into cash? You're trying to sell your building. How long is it going to take you to convert that building into cash?
Closing escrow.
And how long does it take to close escrow? It will depend. Not only that, you have to put it on the market. You have to put it up for sale. You have to have interested buyers. Once you go into escrow can take anywhere from 6 to almost 2 or 3, 4 years, right? Because again, once you go through that escrow process, right, what happens? You're running background checks. You're running to see if the person has enough money to even pay you the money. You have to, that person has to go to the property to see if they even want to buy it. So in this case, and your building can be on the market for X amount of months. It could be there for years, because there's no interested buyers. So in this case, right, how long is it really going to take you to sell your business? If you're short selling it, it could be done in 6 months. If you are doing the proper way, doing the not short selling, then it could take you years to sell that building. So in this case, how easily is it convertible to cash? Not as quick as you would think. So therefore, that is exactly why it's categorized right in the middle. Okay? Now, here's another example of a fixed asset, right? What about furniture? You bought furniture and you used it. Now, and you decide that you want to get rid of it, but you want to make some money out of it. So I want to sell my furniture. How quickly convertible to cash is used furniture?
A sale or transaction?
Yes, in this case, but how long is it going to take you to get to there? You got to put it on a website, right? Whether it's Facebook marketing or whether it's eBay or some kind of place, right? That sells used items. You're going to have to connect to a potential buyer. They're going to have to come over and see the furniture to see the quality of it. And then once they agree to it, then they purchase it and then you get the money and then so on and so forth. But it's the same system as selling your building, right? So in this case, is it easily convertible to cash unless you decide to go to a recycling unit that can give you the instant cash right away, then that's a different situation. But at the end of the day, if you're trying to get some kind of scrap money out of used items, then that's why it takes longer to convert into cash. It's definitely more than 24 hours. Okay, so in this case, that's going to be an example of why your fixed assets would be below your current assets because they just cannot generate the money quick enough. Okay? And then other assets. Other assets are usually going to be your intangible assets. Okay? So intangible assets, right? Intangible meaning you cannot touch it. It's invisible. Right? And those kind of properties can be intellectual properties, such as patents, copyrights, licenses, right? Prepaid accounts, so such as prepaid rent. You paid rent in advance. Can you physically touch rent? No. You can't touch rent. You could touch the contract, but what does a contract mean to you? That's not the idea that's behind rent. So in this case, those kind of other assets, you have ownership over them. However, what is the likelihood you're going to actually get your money out of it? So for instance, right, your rent, you paid your landlord some money and you want to leave that building and you demand to have your money back. Can you tell me how easy it's going to get the money back from your landlord? Probably not as easy because the landlord might fight you on it. Said, no, you signed and leased your contract. You have to go through with your contract. You're here until X amount of days. I don't care. You're not getting your money back. Then you're going to have to go through lawyers and legal issues. And then, of course, how long is it going to take the court to go through? It could take 6 months. It could take a year. It could take a long time to fight a court case. So in this case, how easy is it going to be converting into cash? It will probably be the most difficult one. Okay? So that's how we organize our assets based on current, fixed, and other assets. Okay? Any questions here?
No.
Okay? So we move on to liabilities. Okay? Liabilities is going to be categorized based on the length of time you owe an individual. Okay? Now, who are these individuals that you owe? It will be your vendors, your suppliers, okay? Your 1099 contract workers, okay? People who help operate your business. So again, people who supply you the inventory. Okay? Now, or it could be your bank institute that lets you borrow money to run your business. Now, we categorize them based on the length of time that you owe that individual, right? Like I mentioned earlier. So current assets are going to be listed as people that you owe for at least 1 year, okay? Or at least a year or less than a year, okay? Where your long-term liability is going to be more than a year, okay? So for instance, accounts payable is going to be in a popular account that we will be taking a look at. Usually for accounts payable, you're owing somebody 30, 60, 90 days. That's less than a year. So you're going to create an accounts payable for that. Okay? What about sales tax? Now in this case, sales tax is collected for your sales. So sometimes, depending on the company, you might have to pay them monthly, you might have to pay them quarterly, but for sure, if you don't pay them anytime between then, you have to pay at the end of the year. It's an obligation. Okay? And then, so that's an example of a current liabilities because you owe them within 1 year and you are expected to pay them within that year. Okay? Where your typical loans, business loans, bank loans, student loans, right? Usually those have a longer time frame and expect you to pay back not as fast as your current liabilities, right? Your long-term liabilities usually have a longer extended time, but they are also the kinds that hit you with interest, right? So your long-term liabilities, usually a typical loan, if you get a typical business loan, the minimum is going to be 3 years, okay? And of course, the maximum, if you get a home loan, that's up to 36 years. So in this case, if you're going to owe for more than a year, they're going to be considered long-term liabilities, okay? Now, in English, we think that liabilities is our debt. No. You shouldn't understand it like that. Debt is going to be things that, for instance, when a customer owes you, right? That's debt that you need to collect. But on our standpoint as a business and you owe money to somebody else, it becomes an obligation, meaning you are obligated to pay this person. So please, that's also something that you have to understand is when we're looking at a business standpoint, right? We owe money, it is an obligation, not debt. If a customer owes you, that is debt to you. Okay? Make sure you understand the difference. Okay? One is us owing somebody else. The other one is when customers owe us money. All right? That's how we have to understand the terminology, right? All right. Any questions so far?
No.
I'm good.
Okay. All right. Next one's going to be equity. Okay? What is equity? Now, equity is going to be, again, the net worth of your entire business. Like what does your company, what's the value of your company? Your total value of your company, right? Now, your equity will be made up of other accounts, but there is no categories when it comes to equity, right? Only in corporations you'll start to see categories, but equity does not have any categories, right? They only have main accounts that affect equity, Okay, so example right here is what adds to equity? Capital contributions, which is your own money putting into the company. Net income increases your equity. Anything that decreases it is going to be an owner's withdrawal or a net loss. So again, these things make up equity, and that's exactly why I told you, right? Equity is not solely just your assets minus your liabilities. It's a lot more to it. Okay? This is what makes up equity. Equity is a combination between your net income, any extra money that you invest, as well as any money that you take away from the company. Right? So, what is net income, or what makes up a net loss? Well, then that also brings to our next section, which is going to be your income. How is income generated? Income is generated through your revenues minus your expenses. Now, in business terminology, usually revenues and income are used interchangeably. It doesn't matter how you understand it, but here I'm talking about net income, okay? Not just income itself. But that's what I need to tell you is that in terminology wise, revenues and income are used simultaneously or synonymously, meaning they mean the same exact thing. Okay? Now, let's talk about that again. So if equity includes revenues and expenses, okay, then how do we determine what is a revenue and what is an expense? Revenues is going to be any way that your business generates money through selling products and services. Okay? So this is your way of pulling money into the company by selling a product or service. Okay? So again, under revenues, you have two categories. Okay? Number one is your operating revenue. Now, in this case, since we are looking at operating income or operating revenues, right? We know that if we're looking at a merchandising type of activity, we can also refer that to sales because that is our main core of operations. That is what we do to generate money, is we sell either a product or service, right? So we generate money through sales. Okay? And of course, you have a couple contra accounts here. The second category is going to be other income, or also known as non-operating income, right? So that's going to be your second category, is anything that you generate money outside of the core operations of your business. So for example, right, you charge delivery fees, even though you're an in-store type of business. Your business is not in the business of delivering stuff. It's in the business of selling your product. So that extra fee or that extra income is going to be considered an other income because it doesn't belong to your sales. It's a separate charge that you charge your customers for the inconvenience of having to deliver a product to that person. Okay? Another example too is if you invest into other companies. So yes, you can. A business can invest into another company to take that extra money to support a business. Okay? So again, that could be used as other income as well. Right? Then we talk about expenses. Expenses are going to be anything that is needed to operate your business. Whether you spent the money, whether you used something in the business, or whether you're trying to get rid of something in the business, right? We're just going to use that as an expense, right? We're going to use determining that if we need to spend money to operate the business, then it's an expense. If we need to use something and get rid of it, it's an expense. So again, the expenses are going to be split into three categories. Number one is going to be cost of goods sold. Cost of goods sold is where you're going to be using this in terms to match your revenues, okay? And also get rid of your inventory, okay? So this cost of goods sold is directly linked to your inventory account and your sales account. So get it, hence the words, how much did it cost you to sell the product? Okay. Then, of course, after that's going to be anything that is operating in your business, so operating expense. So again, if you had to pay for rent, you need to have the building in order for you to sell your product. So that's going to be considered an operating expense, okay? Anything that's a non-operating is going to be anything that isn't on the property or facility of your store. So for instance, if you had to pay a separate warehouse to hold the inventory items, again, is that your main core operation of your business? No. That's an extra expense that you have to pay to hold your inventory items. So in this case, that's going to be considered a non-operating expense because you have to pay another warehouse to hold your inventory. Maybe you need to pay for security. Maybe you need to pay for temperature control, right? To keep your products fresh, right? So if that's the case, those aren't in the main operating core of your business, right? Your main core of operating is to sell your product in your store, not to hold those products in inventory. So therefore, that's going to be considered non-operating expenses. Okay? Any questions?
No.
Okay. So this table here is called your accounting model. This is something that I want you guys to have on hand at all times. Now, if you remember, I kind of briefly went over it on the first day of class. If you go to your study materials tab folder, you're going to see a copy of the accounting model. And it's going to look like this, right? We take a look at every single account that we have, right? So our assets, liabilities, equity, revenues, and our expenses. This is what I mean by using the debit and credit system, right? This is how they flow, right? So assets, how do they flow? They normally are increased by a debit, right? And they are normally decreased by a credit. So in this case, that's exactly why I mentioned to you earlier, right? We cannot treat debits as increase and credits as decrease because what if I do it for a liability? In fact, if I do it for a liability, the concept is switched. A debit decreases a liability while a credit increases a liability. So again, this is where we have to analyze what the transaction is at hand and use our accounting model to determine how to use the debit and credit system. Now, how we understand this is when I ask you what a normal balance is for each account, we're looking at how each account is affected and how they are increased to the positive side. So for instance, your assets, how do you increase an asset to the positive side? Well, in this case, you would increase the account with a debit. So that means my assets would normally have a debit balance, right? While my liabilities, what increases my liabilities? My credits do. So therefore, my credits are going to have a normal balance under the liabilities, okay? So let's just take a review look at this. So what you're going to notice is that your assets and your expenses tend to flow the same direction, while your liabilities, your equity, and your revenues actually flow in the opposite direction. They're not contra accounts whatsoever. It's just that's just the normal balance of a transaction. Now let's do an example, right? Using the debit and credit system. Okay? So let's say I had a sale. Okay? If I sold a product, right? What should I normally get out of that? Money, right? Money is what I own. So in this case, in order to record that I earned money by earning a sale, how should I record it? Well, in this case, I am going to increase my cash because I increased my assets because I received money. But at the same time, I also increased my revenues because I just recorded a sale. So therefore, how would you record the increase of a sale? I would have my credit right here. Okay? Now, when we talk about the accounting system, how to use the debit and credit system in chapter 3 here, they have to balance. So if I have, right, one transaction going one way, I need to have an equal and opposite transaction going in the other way. So again, imagine your debits and credits are almost opposite to each other. Okay? So that's one example. I'll do another example. All right? So let's say I am paying off a liability. So I'm choosing to decrease the liability. How would I decrease a liability? Well, right, if I'm no longer owing them any money because I'm paying them off, therefore I need to debit my liability account because that's going to decrease my account. But what else am I also decreasing? Well, I have to pay money. So therefore, my equal and opposite is going to be crediting my asset because I'm decreasing the value of my money that I have because I'm paying a liability. Okay? So hold on to this worksheet because this is going to be very, very crucial for you to have, especially when we start journalizing in the next chapter. Okay? We're gonna actually practice journalizing. Okay? All right. Bookkeeping systems. There are two bookkeeping systems, single entry and double entry. Okay? Single entry allows you to focus on one transaction, in this case where you're only affecting one single account at a time. Okay? So what does this even mean? Well, think of it. Let's say you bought something and you paid with a check, right? Usually if you're handwriting a check, your checkbook should have a little booklet at the top of your checkbook, right? And you would record the transaction there. But in this case, I'm only affecting one account. I'm only affecting my checking account because I'm recording it only in one place, one account, right? Where in this case, right, whatever I bought or whatever I paid for, I cannot identify that because I didn't record it in that other area. Did I purchase something? Did I purchase an asset? Did I buy inventory? Did I spend money for an operation? So did I create an expense? Am I paying for a liability? We don't know because you only recorded it into one place, which is just your checkbook. Right? So again, that's called a single entry accounting system. Okay? Now, we don't use this because this is how our checks and balance do not balance because we're only putting into one account. So what does a double entry do? Now, a double entry allows us to record our transaction in two or more accounts. Okay? So this is where our totals must equal at the end of the day. So that's where you need to remember this fundamental rule here is that when you are journalizing and using the double entry, you are having your total debits equal your total credits. Okay? So a great example would be if you decided to pay for a cash register, right? Well, in this case, a cash register is an asset. So you would increase your fixed assets. But at the same time, you had to pay money. So your equal and opposite credit, in this case, would be or your equal and opposite transaction would be decreasing your checking account because you paid for it, right? And your asset is your checking account. So therefore, I have a incoming debit and an equal and opposite credit. Okay? So this is also science applied too, right? If there's an action, there's an equal and opposite reaction. Okay? That is the double entry system where we are recording the transaction in multiple accounts and they all balance at the end of the day, meaning the total debits are equal to the total credits. Okay? This will make more sense when we dive into the journal, but in this case, just know that we, in this class, are going to be using the double entry system so then our books can balance at all times. Okay? Any questions?
No.
Okay. So that ends our lecture here on chapter 2, right? We talked about what the definition of the accounting is. We talked about the accounting equation. We talked about the accounting model and how your debits and credits affect a specific account, right? We talked about how debit is referred as left and your credits is referred to as right. We talked about what the normal balance means. Okay? We also talked about your temporary versus your permanent accounts, which are listed here. And we talked about each and every single account and what their categories are. So again, your assets are broken down into 3 categories. Okay? Your liabilities are broken down into 2 categories. Equity, once again, in capital letters, do not have any categories. But the reason why I listed these things are down here is because they affect your equity. Okay? And of course, your income is broken down into 3 categories, and your expenses are broken down into 3 categories. Okay, well, actually, it's supposed to be 2 for income because other income and non-operating income are usually the same. Okay? All right. So let's go ahead and dive into our chapter 2 exercise here. Okay? And let's review what we learned today and also apply our knowledge. Okay? So number 1, what are the 5 types of accounting? Or 5 types of accounts?
Permanent account and a temporary account.
Those are those are those aren't types of accounts. Those are what happens at the end of the accounting period. They have to stay open versus closing. Go ahead.
Receivables, expense, payable, assets, liabilities.
Okay, a lot of those. So let's break it down. Asset is, yes, it's definitely one of them. Okay? You said payables. Payables are what? Payables are your liabilities. Right? What else? You said revenues.
Revenues.
Equity.
Equity.
And expenses.
And your expenses. Okay. Again, there's only 5 and 5 only. There's no more, no less. Okay. Number 2. What is the main account?
Accounts that make up a list.
Good. But what particular makes a main account unique?
A certain type of account.
It's a certain type of account, but in this case, it breaks down the account, right? But in this case, does it flow in a specific direction? Okay. Now, what does a contra account do?
Gives the main account more detail and flows in the opposite direction as the main account.
Good, right? But in this case, gives main or sub, it could be both, account more detail and flows in the opposite direction as the main or sub account. Okay, good. What does left mean?
Debit.
It means debit. What does right mean?
Credit.
It means credit. Good. Number 6. What is the accounting equation?
Assets equal liabilities plus equity.
Assets equals liabilities plus equity. Good. Okay. What are the 3 categories of assets?
Current assets, fixed assets, and other assets.
Good. Current, fixed, and other. Okay. What are the 2 categories of liabilities?
Current and long term.
Okay. Good. Don't ever refer them to short-term and long-term liabilities. It doesn't work. It's current and long-term. Okay. What are the categories of equity?
Total value of a company or net worth plus the capital contributions and net worth minus the owner's draw or net loss.
Okay, that's what makes up equity. My question is, what is the categories of equity?
It doesn't have any.
Good. There are none. Okay. Number 10, what are the categories of expenses? use your review sheets if you are stuck.
Operating expense, rent expense, and purchase expense.
Okay, operating expense. Now, all the things that you listed are all considered operating expenses.
Cost of goods sold and non-operating expense.
Good. COGS for short, right? This is directly correlated to inventory and your sales. Okay. And then you said non-operating. Good. What are the two categories of revenues?
Operating revenues and other income, non-operating revenues.
Good. Operating income, and then this one could be non-operating or other income. Good. And then number 12, what is the two accounting systems?
Single entry and double entry.
Excellent. Single entry, double entry. Okay.
What's wrong? You're okay.
Number 13, what is the normal balance?
All debits must match all credits.
That's the goal, but that's not what determines a normal balance.
Positive balance.
Yeah.
What was it?
Positive
ahead, Norman.
balance
Good.
that increases in any specific account.
Perfect, right? Positive in a specific account which it increases. Good. All right. Number 14, this will be your practice here. So I'm going to give you a list of a bunch of accounts, and your job is to determine three things. Number one is going to be determining what account type they belong to. So you got your assets, liabilities, your equity, your revenues or income, whichever one you want to use, and your expenses, right? There's only 5 types, right? You're going to identify the type. Next, you're going to identify the category, right? Which is are they current? Are they fixed? Okay? Are they operating? Okay, are they other? Right? So, and then of course, you're going to determine what the normal balance of each account is. So, this is where you need to take out your accounting model because that's what's going to help you understand what these accounts are. And this is how we're going to practice how to determine each account and what they represent. So, the first one we have here is your checking account. Money that is in a bank, or in this case, your bank. So, what is your checking account considered? What type of account is a checking account? It's money that's in the bank.
So it's an asset.
It is an asset because you own the money in the bank, right? Just give me 1 second. I'm going to format this. Good. It's an asset because you own the money that's in your bank. Now, what kind of asset would a checking account be? What form?
Bill,
Say that again.
liability,
Okay, so that's not a category of an asset. What kind of asset? So remember, what were the three categories of assets? We just did it right here. Okay, so what are the categories of assets? Right, current, fixed, and other, right? What would money in the bank be? How would we categorize our assets? Remember, it's based on liquidity. How liquid can you convert it into cash? So, what is money in a bank account?
current,
It's current. It's instant cash. You just go to the bank and boom, you got cash already. Okay? So good. It's current. Now, this is where your accounting model is going to come into play. What would normally increase an asset? Debit or credit?
debit,
Debits increase your assets. Okay? So good. That's the first one. What about an accounts payable? Money that you owe to vendors. Money that you owe to vendors. What kind of account type represents things that you owe to other people?
Expenses.
Not expenses. Those are paid for. Right?
Liabilities.
They are liabilities because you owe them, right? So remember, assets is everything you own. Liability is everything that you owe. Equity is the net worth of your company. Revenues is what you generate money into your company. Expenses are things that you want to spend, use, or get rid of. Okay? So in this case, out of those 5 things, we owe. So therefore, it's a liability. Now, what kind of liability?
Operating.
Okay, so let's take a look at the categories of liabilities. Okay, what are your categories for liabilities?
current and long term,
Current and long term. So in this case, what kind of liability would owing a vendor be?
current,
Long term.
Well, in this case, would you okay, a vendor could be your supplier. Would a supplier would want you to pay them back in 3 years? Most likely not. They would probably want you to pay within 30, 60, 90 days. So that's definitely less than a year. So for sure, it's going to be 100% current. Okay? Good. Now, once again, your accounting model. What typically increases liabilities? So what's the normal balance? Debit or credit?
Credit.
Excellent. Okay, let's keep on going. Copyrights. Copyrights are going to be a legal documentation of ownership or rights. Keyword ownership. Copyright. What type of an account is a copyright?
Long term.
Okay, that's not a type. There's only 5 types of accounts.
Owner's equity or expenses.
permanent,
Not necessarily. because
Liability.
it's not a liability because, again, you have ownership. This is your title.
Asset.
It's an asset because you own it, right? You own this copyright. It's intellectual property. Right? So what kind of asset? So let's review. What are the three categories of assets? Where would a copyright fall under?
Other assets.
It would be other assets because that's where your intangible or intellectual property would be because you can't physically touch it, right? We said that was a characteristics of other assets is you can't touch it. So in this case, that's correct. Other asset. Right? Now, what would normally increase an asset? Debit or credit?
Debit.
Debits increase assets. Good. Okay. Okay, so next thing we have here are supplies. Supplies that are needed to operate the business. Okay, so think of it, so when you go to the store and you purchase those supplies, what happens to those supplies? Who has ownership over them? Good. Those are assets. Now, what kind of asset would supplies be?
Current.
Current, right? Because you could go back to the store, return it, get your money back. Or second thing is you can open them up and use them and create an expense out of it. So in this case, that's correct. They are current. And what kind of normal balance would it have?
Debit.
Bless you.
Thank you.
Good. All right. What about loans? Owing money to a bank over a period of time. A loan. You borrowed money from the bank.
Liability.
You owe money, which is correct, a liability. Now, typically, loans, what kind of liability would a loan be?
Long term.
Long term, right? Because you could owe them for definitely more than a year. Unless it's specified saying that it's a 6 months short term loan, then you would put that under current because it's only 6 months. But in this case, that's very specific. In this case, many typical loans, especially business loans, are definitely beginning at 3 or more years. So good. Now, what is the normal balance of liabilities?
Credit.
Good. Okay. All right. What about accounts receivable where customers owe the business money? When customers owe the business money.
Revenue.
Okay, so in this case, it's not a revenue. We already sold the product to the customer. In this case, the customer decides to owe us the money.
Liability.
Okay, so liability is when we owe people money. In this case, people owe us money.
Asset.
It is considered an asset because, again, It's money that is technically ours. We just haven't collected it yet. So in this case, if it's money that is ours and we haven't collected it yet, what kind of asset would this be?
Current.
It would be definitely current because you're not going to come after your customers a year later. You're going to come after them 30 days, 60 days, 90 days, maybe even almost instant. You might give them terms of just only 3 days. You owe me 3 days. So you better pay me back. So in this case, it is definitely current because you can easily convert your IOUs into cash. And what kind of normal balance would this have?
Debit.
Debit. Good. Now, here's a tricky one. Okay. Owner's withdrawal, where you're taking money out from the business.
Owner's equity.
It is an owner's equity. Right? Now, what kind of category does owner's equity have? Where would this fall under?
Current.
Okay, let's try again. Let's take a look at what the categories of owner's equity is. What kind of categories does equity have? So it has none, right? We answered that in question 9. That equity has no categories. So in this case, we don't need to put anything there. Now, here's the trick question. What kind of normal balance would an owner's withdrawal have on equity?
Credit.
Okay, now, is it increasing equity or is it decreasing equity? How does an owner's withdrawal, if you're taking money away from a business, how does that affect your equity?
So then it would be debit.
Yes,
Decrease.
it decreases your equity. So in this case, this would have a debit balance. Okay, so good. That's a trick one. Okay. What about advertising expense? Marketing for the business.
Expense.
It is an expense. Now, what kind of expense?
Operating expense.
It would be an operating expense because you need to have advertising expense in order for you to run your business. So in this case, good. Now, what kind of normal balance would expenses have?
Debit.
Yes, they are increased by a debit. Okay. What about cost of goods sold? Okay, where you calculate the cost of items that you sell.
An expense.
It is an expense. Now, what kind of category?
Cost of goods sold. Costs.
Good, excellent. Right? It has its own separate category. And what kind of normal balance would it have?
Expense. So it would have a debit.
Good. It would increase with a debit. All right, inventory, right? Items that you purchase that you plan to sell. So that's a key word here, that you plan to sell. Go ahead.
I was going to say it's an expense as well.
What happens
or
when you actually purchase the inventory?
it becomes part of your inventory.
It becomes part of
So
your
it
inventory.
becomes revenue.
Revenues is how you generate your money. Is that part of your business? As in, when you buy a item, who owns the item?
You do.
You do. So in this case,
So it's a liability,
that's what you owe.
asset.
It's an asset. Good. So in this case, right? Because here's the idea. If you're purchasing these items to have a purpose for them that you plan to sell, right? When you purchase them, you
Yeah,
own
that makes
them.
sense.
As soon as you sell them, they're no longer your property, right? That the shift of ownership becomes to the customer. Now in this case, I'm not talking about selling the product itself. This is purchasing the items that you do plan to sell. Okay? So there, it is an asset. Now what kind of asset?
Current.
It's current because you can turn around and convert this inventory into cash by selling it. And what kind of normal balance would this have?
Debit.
Debit. Excuse me. All right. What about land, which is property?
Asset.
It's an asset. What kind of asset?
Long term.
There's no such thing as a long-term asset. What were the categories of assets again?
Fixed asset.
Fixed asset because it belongs to the PP&E, right? Property, plant, or equipment is what's going to identify these items as your fixed assets. Good. All right. Now, what kind of normal balance would this have?
Debit.
Good. What about sales? Sales is where you earned money from selling a product or service.
Revenue.
Revenue or income, if whatever one you want to use. I am having typing issues today. There you go. Okay. Now, what category of sales would sales be under for revenues?
Product or service?
We're talking about category. How would you categorize your sales? What are the categories of revenues? So how would you categorize your revenue?
It will be a receivable.
Not a receivable. Okay, so here, let's take a look. This is the categories of revenues, right? We just talked about this. There are two categories of revenues. What are they?
Operating income.
Operating income and non-operating. In this case, sales is the main core of your operations, right? That's your main goal to generate money. Now, in this case, because we are in we are using merchandising type of business activity, either, sorry, I lost where I am. Okay, so either you can either categorize your sales as operating, or if it's just the only category there because you're merchandising, it could be also known as sales, right? Because it's your main core of generating income. So what kind of normal balance would that have? Would your revenues have?
Credit.
It would have a credit balance. Okay?
How do we know that?
How do you know what? That it has a credit balance?
The accounting model, slide 12.
Yep, the accounting model. So remember what the normal balance means, right? It means which side is an account increased by, or that gives you the positive, right? So in this case, when I look at my revenues, what increases my revenues? Debits or credits?
Credit.
Credits. So that's how you know.
Okay, thank you.
All right. Couple more. All right. So we have capital contributions, right? In investing money into the business. What is that going to be considered? If you're trying to invest your own money into your business.
Owner's equity.
Owner's equity. Okay. Now, what kind of categories does owner's equity have?
Long term.
No. We just went over this. Okay. What kind of categories do equity have?
None.
None. Okay, so in this case, no categories. That means you're not going to categorize this, right? However, what kind of balance would this be for owner's equity? This time, does a capital contribution, if you invest your own money into your business, right, are you increasing equity or are you decreasing equity? If you put your own money into the company,
Credit.
you're going to increase it with a credit. Good. All right. Next one is equipment. Okay. Any type of machinery or object to run operations. Okay.
Asset.
Asset. What kind of asset?
Fixed.
Fixed. Excellent, because it belongs to the PP&E, right? Property, plant, or equipment. Okay, good. So, what kind of normal balance would this have?
Debit.
Debit. Good. All right, couple more, and then we are done. Last one, notes payable. IOUs to other people. So this is you IOUing other people.
It's either liability or expense. I'm not sure which.
It's a liability because you're writing these IOUs to other people, right? You're going to say, I'm going to owe you money, right?
Okay.
Now, what kind of liability?
Well,
Long
long
term.
term.
It can be long term. It can also be current. Now, let me explain. Now, an IOU, what's the difference between an IOU and just straight up owing somebody? Yes, there's a difference when you owe somebody money and when you write an IOU.
Cost and payment plan?
Payment plan. You can negotiate your IOUs. You can say you can defer your payments, meaning you can extend the time frame because it is your promise that you're going to pay back this individual and you're not giving them a set time frame, right? It's negotiable. So that's the huge difference. So that's why I said it can be current, it can be long term. I can say, hey, can I owe you in 6 months? I'll pay you back. If not, I'm going to say, I'm sorry, can you give me another year? Okay, then that was 6 months plus a year. So that becomes a long term liability, right? So again, that's the difference between regular loans that you have to straight up pay and it's a responsibility versus an IOU. You have the ability to defer and negotiate payments, right? Have a payment plan. So that is what a notes payable does. Okay, and what kind of balance would this have?
Credit?
Credit. Good. Okay. All right, next one is going to be rent expense. Paying for rent.
Liability or expense.
Okay, you don't owe you won't owe the rent if you're paying it, right? So in this case, yes, you are correct in the fact that it is an expense. Now, what kind of expense would this be to a company?
So the liability is, I'm so sorry, can you go over the difference one more time of liability and expense?
A liability is when you owe somebody money. So in this case, if I'm paying the landlord, I'm not owing the landlord any money. I'm paying them off right now. So that's the huge difference there is one, you say I'll owe you money. Then that's a different, then that's where that becomes a liability. But in this case, I'm paying for something I need to operate my business. I'm paying for rent. So what in terms of, so expenses are what you need to spend for your business, what you need to use for your business, or for things that you need to get rid of from your business. Yes.
How come it's not a fixed asset?
It's not a fixed asset because it doesn't have any of the properties, right? Is it property? If you're paying rent, do you own that land? Technically not if you're paying rent, right? You don't own that land. Are you renting the building? Now, do you own that building? Technically no. And is it equipment? In this case, right, let's talk about tangibility. Can you actually physically touch rent? Yes.
Is rent the same thing as like having the property in your control?
Yeah,
So
but well, someone else controls the property, right? You don't. You just rent it out, or you just occupying that space. So, for instance, if you're renting an apartment, do you actually own that apartment?
What's wrong, sweetie? Okay.
I mean, is it the same thing as a loan?
It's not a loan because you're not borrowing the property.
So just regular rent too, like an apartment that you don't own is an expense.
It would be an expense because you need you need the space in order for you to operate your business, right? You need to pay the location for the space that you're going to occupy, right? So rent can be very tricky because there are other terms, when we look into prepaid accounts, that rent can be considered something that you own. But that's just because when you pay a landlord in advance, that means you own that space for that period of time. And that the landlord owes you that time frame. Okay, so that's different. Now in this case, I'm paying for rent, which is the act of occupying a space, right? But what do I need this space for if I'm using the area for the space? You're not owing the landlord any money, right? If you do, then that will become an accounts payable. If you own the property, right, and you're renting out your own room in your own property, then that, of course, will become a building expense. Or not a building, it'd be something that you own for the building. But in this case, I'm occupying a space, right? And who owns it? My landlord owns it. So yes, I can do whatever I want to put my own stuff inside, but at the end of the day, if that contract is over, guess what? I'm kicked out because I don't have ownership over this apartment. I am literally paying by contract, right? Yes, you can act the apartment like it's your own, but what happens if you damage the property? Who pays for that? You do, because you damage someone else's property. Is that more clear?
Yeah.
Okay. So in this case, this would be an operating expense because I mentioned it a couple times because we are using it to operate our business. All right, we're occupying a space for us to sell our product. So again, what kind of normal balance would that be?
Debit.
It'd be a debit balance. Good. Okay. Let's see. What about delivery income? Okay, where you charge your customers to cover the delivery charges. Okay, and let's say your main core of operations is selling a product or service, right? You're not in the business of delivering. What would delivery income be?
Operating income?
Not operating income.
Expense.
It's not an expense because you're charging customers to cover for the delivery charges.
Other income.
Other income is correct, right? Because again, your main core of operations isn't to deliver to your customers, it's to sell a product. So in this case, this is considered income, revenue/income. Okay? And it's other income. Okay? So what kind of normal balance would this have?
Debit.
This would have no, not debit. How do you increase your revenues?
Credit.
You would credit. Okay. Last account here, we got purchase expense, making purchases for the business for the operations or inventory items. So you can use purchase expense for multiple things, but in this case, we use it for inventory. So in this case, you are buying it intentionally for the main core of operations of your business. So what would this normally be? What kind of account would this be?
operating expense?
Yes, it is an operating expense. Okay, so therefore it's an expense, right? And what kind of normal balance would this be?
Debit.
Debit, right? Okay, so before you guys go on break, let me help you guys out here. Now, in most cases, when you occur an expense, right, you would normally see the word expense attached to each account. So you're going to have, again, liability expenses, right? Or, sorry, not liability, purchase expense, advertising expense, license and permit expense, okay? So those are going to be your expenses. This is going to be blanked. They're pretty straightforward. They're going to have the keyword expenses in there automatically, okay? Now your liabilities are going to have the keyword payable in it, okay? So again, notes payable, accounts payable, loans payable. In this case, loans payable isn't there. It's straightforward that a loan is going to be a long-term liability, but most cases like sales tax payable, right? Interest payable. They're all going to have the keyword payable because you're going to owe it, okay? Now, the more difficult one is going to be your asset because assets, they can be almost anything that's on this list, right? But all you have to do is just ask yourself, do you own it? And then that will determine whether it's an asset or not, right? Do you own the supplies? Yes, you do. Do you own inventory? Yes, you do. Okay? Do you own your sales? No, you don't. Okay, so you see how straightforward that is? If you just ask yourself, do you own it? Equipment, do you own it? Yes, you do. Do you own your copyrights? Yes, you do. Okay, do you own your operating expenses? No, you don't. Okay, all right, so that's breakdown for you to kind of help you kind of easily identify these accounts. Now, again, use this to practice because, again, we will be seeing these accounts over and over and over again. So these are the typical accounts that you would normally see for this type of business. So again, there's going to be also plenty more accounts that you will see further down as we go through the lesson. But these are the main core accounts that I want you to kind of get familiarized with. Understand what they are, understand how to categorize them, how to determine the type, and determine the normal balance for each and every single account. Okay, you will be tested on this, so again, please make sure you do